Good morning, and as always, welcome to today's Five with Fitz. I'm Keith Fitz-Gerald. Thank you for joining me. The markets were red and early going as all three indices retreated ahead of the Fed, or so the story went. Then they went green, then they went red again. Makes my head spin. Anyway, we've seen this movie so many times, we know the lines by heart. The U.S. 10-year yield, the 10-year note, Treasury, hit 4.09% this morning. So the go fast crowd sold down enough to get under what's called VAR limits, value at risk. That's how much money they've got in hand, leverage and all. And so you want to be under that level so you don't get a big world-class margin call and have to sell. So they sell fast and hard to get under it ahead of time. Anyway, then they also did a little house cleaning and the obligatory head fake to separate the weak hands from their money. There is no doubt in my mind that they'll be back on the gas shortly. That's how the game is played. Repeat after me. This is very important if you're an investor, by the way. Repeat after me. This kind of up and down around the mulberry bush market action has nothing, repeat, nothing to do with the business case for owning the world's best companies, which, by the way, and as we talk about every week, is getting stronger by the day. Rates are for traders, but profits are for investors. And there's a big difference. Now, history shows very clearly that it is always better to play offense, even if you have to think defensively to do it. Oh, and while we're at it, buy the best, ignore the rest. Again, here's my playbook. Number one today, AI doesn't matter if the lights go out. All right, Team Carp, you know who, as in Team Carp of Palantir, has just lobbed another grenade into the AI arms race. This time, it's a new platform called Chain Reaction, and it's aimed squarely at the one bottleneck that Silicon Valley still pretends doesn't exist. Everybody's yapping about models and chips and benchmarks. The valuation gang is, of course, out in force. The naysayers and nervous Nellies, too. Meanwhile, the real constraint and the real opportunity is old school and utterly unavoidable, in my humble opinion. Something we have talked about many, many times over, and with which the OBA, One Bar Ahead family, is intimately familiar with because of the profit potential. Power, grid stability, and the physical infrastructure needed to keep the AI fire hose running. That's the stuff that really matters. Now, Chain Reaction launches with Centerpoint Energy and Nvidia, a trifecta that you do not assemble if you're not dead serious. And they're going to modernize the crusty power systems, harden the grid, and fast-track hyperscale data centers. This isn't rocket science, at least to me anyway. AI is leaving the look at what my model can do stage and entering the industrial build-out phase where fortunes aren't made in code, but they will be made in stuff like concrete, copper, and kilowatts, and of course capacity. Now, Burry and his Boop Brigade, and you know what that stands for, can crow all they want. The Code Squad too. Team Carp, meanwhile, will conquer what actually matters. And investors who latch on stand to make out like proverbial bandits. Again, Keith's investing tip in this department. I see a lot of folks around the world trying to be right now. There's two rights there. Anyway, trying to be right when the world's best investors constantly focus on being profitable, even if they're wrong. And there's a big difference that's important to you and your portfolio and your money. Now, number two today. This is just in from GM's Nice Try department. General Motors has a new tech sheriff in town, Sterling Anderson. He's an ex-Tesla Aurora exec who's now running product, software, batteries, manufacturing, engineering. Basically everything short of sweeping the floors. He's probably got that covered too. Now, he says that he views GM as a canvas for innovation, while CEO Mary Barra is hailing him as a visionary who will finally unify software and hardware into one seamless modern operation. Right. Let's talk about reality. GM has burned through a parade of Silicon Valley hotshots, Tesla veterans, Apple folks, Google alumni, most of whom lasted about as long as a Michigan summer. 3 more top software and AI leaders just quit, in fact. Now, my take is that every time GM unveils another bold pivot into EVs, autonomy, or the future of mobility, whatever you want to call it, it usually ends with a restructuring, a write-down, or a quiet backpedal. Anderson is undoubtedly brilliant. I mean, don't get me wrong, but even he admits that he worried GM would treat him like an outsider. Personally, I think that's probably inevitable. Legacy car makers seem to have an unwritten slogan: 100 years of tradition, unimpeded by progress. GM desperately wants Wall Street to believe it's having a tech renaissance. But you know what? No amount of window dressing or swagger will fix decades of whiplash strategy, cultural inertia, and leadership churn, in my humble opinion. So, Putskis, I bet the stock will go down, and continue to buy the other car maker that's actually cut a very real path forward, and which, by the way, has already produced millions of cars, every one of which is capable of running circles around even GM's best products with no driver needed. And you know who that is. Anyway, number 3 today, I biffed Salesforce. Should you buy it? You know, this is a very, very tough business. And while I am fortunate to get a lot right for a very long period of time, stepping up to the plate regularly means I'll occasionally foul one out too. So, case in point, I said Monday that I wasn't enthusiastic about Salesforce and would sit out this earnings call. It's time to eat some crow, as the old expression goes. Salesforce beat on earnings and even raised its revenue guidance for Q4. EPS hit 325 versus 286 expected. I mean, that's big. Revenue landed at 10.26 billion plus 8% year over year. Free cash flow jumped 22% year over year. I mean, wow, that was big. And then Agent Force was the real highlight. Over $500 million in annualized revenue, up 330% year over year, with 9,500 paid deals now in the bag, if I've got my numbers right. Should you buy the stock? Well, that's the real question. Personally, I'm not inclined to buy still. And I'll tell you why. Salesforce is growing at single digits, while true AI platform leaders, including Microsoft, Nvidia, PLTR, other names we talk about frequently, are well into the double digit. This quarter, what Salesforce just did reminds me a lot of Adobe during its infamous transition years. You know, a lot of investors lost their you-know-what when that happened. Solid fundamentals, plenty of optimism, lots of promise, but the market wasn't convinced until years later when the proof finally caught up with the pitch. Now, I don't think the bottom's in yet with regard to Salesforce. So, again, Putski's a bet that the stock declines, short or avoid. But that's just me. If you own it and you like it, good on you. Investing is individualized things, not a competitive sport. My investing tip in this department: longer-term investing success revolves around constantly weighing alternatives. I'd rather invest in choices without the baggage, but that's just me. Number 4, oh no, now Nvidia has a cash problem. I mean, seriously, where do these people get this? CNBC is reporting that Nvidia has a cash problem. Like, that's a bad thing. I mean, this kind of stuff makes my brain explode. It's nuts. The media is paid to garner eyeballs, which means that what you read is intended to help them do that, not help you make money. Big difference. God forbid they spin stories positively. I mean, Nvidia is doing exactly what Nvidia should be doing best, using its war chest, which is now $60.6 billion, to build an unassailable AI empire that doesn't depend on regulators, politics, or disapproving journalists who have never, I might add, run a company at scale. Nvidia will generate nearly $100 billion in free cash flow this year and is projected to rake in something like $570 plus billion over the next 3 years. I mean, and if that's a problem, so be it. Sign me up. All right, number 5, the tough part about easier fuel efficiency standards. Now, yesterday, I called to your attention that the president was rolling out tougher fuel standards and made the case for investing where electrons were cheapest. Now, several of you actually wrote in, took the time, thank you, by the way, saying that I must be mistaken because he's rolling back Biden-era policies. And isn't that easier? Thank you for your sharp eyes, and thank you for writing in. And forgive me for not explaining my thinking in more detail. My coffee hadn't kicked in at 4:30 in the morning when my brain cramped and I actually penned that. So let me explain now. Yes, the rollback makes compliance easier for car makers by slashing compliance costs and the stringency associated with fuel standards. Now, my POV is that that's actually tougher because doing so will likely result in worsening real-world fuel efficiency, higher long-term pump costs for consumers, and, of course, a significant strategic disadvantage versus China over time. Now, I don't do politics, so let's keep that off the table. I do money. And here's the rub from an investing perspective. Well, President Trump tells GM, Ford, etc., they don't need to make gas-saving cars by reducing the pressure to catch up via what are widely considered to be, considered by many to be flawed electrification policies, China is telling car makers to go ahead, their car makers, and grab the world's burgeoning clean car market because they know the move potentially guts U.S. competitiveness and innovation. Now, that is definitely a tough spot when you see it through that lens, and an investable opportunity if you know what to look for, like the OBA family does, which, by the way, already has this covered. So anyway, you can learn more about that on my website if you like, and I hope you find it helpful. Bottom line today, your job as an investor or a trader isn't to figure out where the markets go next. It's to recognize that they're in motion, then act on the signals created when that happens. You got this, I promise. As always, let's make it a great day. Thanks for watching, and I'll see you tomorrow. Cheers.